This is the economic review on Business AM. Now, the shilling on last week Thursday breached the 110 and 5 cents mark against the dollar during early morning trade, extending a run of a record weakening for the local currency, clawed black by some ground to close at 109 and 90 cents. Its performance is expected to remain shaky in the short term due to declining foreign exchange inflows, which have always come in handy in stabilizing the shilling through the interventions in the repurchase agreements that's in the repo market. This morning, therefore, to help us understand this state of the Kenyan shilling against the greenback, I'm going to introduce Gabriel Mwendwa as we go by, investment associate at Horizon Technologies. Let's talk about that. At Horizon Africa Capital. Gabriel, as expected, isn't it? Good morning, by the way.
Good morning, Jay. So I think on the Kenya shilling, this is something that I think we've had coming for quite a while. From speaking to international investors, it was always a question that kept coming up, about expected depreciation of the shilling, or they are not. Being that the central bank has defended itself that the currency is not a controlled one, and the fact that those accusations are there and those discussions are being had, raises a few questions here and there. If you look at, if I can pick the Ugandan shilling as a comparison.
Yes.
Back in 2016, the UGX took a one-time hit from about 3,300 against the USD, went up to 3,600, a 9% decline, never gone back to the previous level. So it moved from that level to this level, and it's never gone back down. Same thing happened to the Kenyan shilling in around 2011. We were in the 80s, 90s, we jumped to 100, never gone back. So over this time, when, our fundamentals, if you look at the fundamentals, have been worsening off. If you look at deficit to GDP, if you look at debt service as a percentage of revenue, if you look at debt to GDP, those are the fundamentals I'm talking about that investors also look at is what could determine the future. They have been worsening, but we've not taken a major hit over that period of time since, say, 2015 to 2019. We've just been ranging about 100, 103, and thereabout. So there has not been a major readjustment currency to factor in all those changes in the fundamentals. And I think with the pandemic, we just could not hold it back. So this might be a situation whereby the shilling actually maybe continues depreciating and then comes back to around this level of 108, 110, or stays at this level and we never see it going back to the historical levels of 104. So really the issue has been those fundamentals worsening. And I think really my view, it's a fundamental issue. It's not technical whereby it's going to go up and then come down. This might be the new rate that we look at going forward.
Yes. Gabriel, I'm going to come back to you because if you look at the man at the regulator, that is Central Bank of Kenya Governor Dr. Patrick Njoroge, has been quite a bit about a Kenyan shilling. Let me just bring in Tommy this morning. Tommy, yes, if you look at what the regulator was telling us, that, well, we are fine. If you look at our exports, we didn't have a bigger account deficit, and it's talking about also international remittances, which surprisingly, despite them being lower this year, they've been on an increasing level. For you, from where you sit this morning, do you share the same sentiment with Gabriel that these are just the fundamentals that are getting wrong for the country?
I agree with Gabriel 100%.
Yes.
The fundamentals here are a huge issue.
Yes.
Also, the US printed $3 trillion that they put into the economy when they were doing a stimulus for the COVID. So there's a lot more dollars in the market than normally would be. I actually thought that the value of the dollar would go down, and this is completely opposite from what I would have expected to happen based on how much money is pumped into the economy. So like Gabriel said, the fundamentals, we go back to the fundamentals, and that's the reason why the dollar is getting so much value.
All right, now, Gabriel, let me bring you back in again now as well. If you look at what Dr. Patrick Njoroge is saying, is that, well, why are we questioning the way in which we value our shilling? From what you said this morning, would you say that, yes, we are overvaluing it? If you say then that our fundamentals have been, well, basically not here nor there.
You see, valuation is, you have a valuation model, and then the inputs change over time.
Yes.
So the few aspects that we've mentioned, debt to GDP, the deficit levels, all those things have changed over time. So he cannot expect the value we had in 2016 to be the value in 2019. Yet we've added 1-2 trillion of debt to our country. There's no way then the inputs are the same. You can't have the same value. Every decision you make has an effect. So loading up that debt, and then it does not increase our output. For example, look at our exports. It's a third of the imports. How are we supposed to? So it means you have 3 times more people who need dollars every day for trading than the people who are getting them into the country. So as much as we have strong remittances, if you look at the remittances over that time, the change has not been as much, or cannot be compared to the change in imports.
Yes.
It cannot be compared to the change in how much we are repaying to our lenders. So those are the things that really determine the expectations of the country. And our currency is really a signal, because our interest rates are still attractive for investors to come and invest in this country. Banks are doing well. So that sector could still attract investors, which strengthens the currency. But the challenge is that people are taking a view on the country as a whole. So they're taking the country as a company. It's a tough comparison, but if you look at it as such, then, like I said, the fundamentals have really changed, and the valuation model, the model could remain the same, the formulas are the same, but the inputs are very different. We are not the same country we were in 2016.
Pretty much. Tommy, just clear for us this conversation. Therefore, do you expect that things are going to a big change towards the end of this year, or this would be just about the new norm? Because, and remember, the 110 mark was the one that we were sort of saying that we should not touch, but it looks as if we're touching 110, 108, 107. So is it going to be the new norm, or do we expect for things to get back to the 90, the 97 that we're used to?
Mm-hmm.
I think this is the new normal, Simba, because the way things are going, and based on the valuation of the dollar, and based on those inputs that Gabriel has mentioned,
yes,
this is going to be the new normal.
Badly off, man. All right, let's move on to the next part of our discussion this morning. Well, still on the shilling, not looking friendly. Let's shift our focus to Central Bank of Kenya data, which now indicates that lending rates fell to an average of 11.75%, occasioned by consistent drop in the regulator's benchmark lending rate. Now, this latest mark represents what will be the lowest average lending rate since the CBK started disclosing the rate in July 1991. There were fears that the removal of the rate cap was likely to see a return to the era of high cost of loans, which had at one point hit 25%. Now, the CBK allowed banks to restructure loans and residual payments for customers suffering under the pandemic ever since COVID-19 first hit Kenya, which has seen the banks restructure customer loans facilities worth more than 1 trillion to cushion borrowers from the impact of the pandemic. In the past, some bank bosses have blamed the regulator for taking a customer approach as opposed to an industry approach, which has seen the banks face an uphill task in pricing their facilities. And if you look at that data that we have there for average commercial bank lending rates, you will see that, well, it has been on a dropping trend. Nothing is pretty much improving. It looks as if, despite the removal of the cap on interest rates, Gabriel, the banks still do not have that liberty to price their loans. Well, let me take you back to the time when it was stamped out. If you look at guys like the CEO for KCB, Joshua Igare, came in and said, well, it's bye-bye to the era of expensive credit. The 20% gone, the 25% gone. But they did not expect to get stuck at 11.75%. Gabriel, why do you feel like, well, the industry is overregulated? Yes, we seem to be having a technical difficulty in crossing over to Gabriela this morning, and we're on that area where we're talking about how interest rates now in the banking industry have been on the lowest since 1991, since CBK started disclosing the interest rates. Yes, Gabriel, can you get me now?
Yeah, I can get you. So, as I was saying that previously we've discussed and looked at the different areas that the CBK sort of has a hand in.
Yes.
When we look at a normal bank.
Yes.
So, with the interest rate cap, they had a hand in the deposit and the lending rate. Now, with the waiver they've given for the better part of this year on transaction charges, that's affecting the non-funded income. And we've seen banks restructure to realize a lot of cost benefits. So if you look at the normal bank right now, there is nowhere else to get profits from other than to increase the interest rate they're charging.
Yes.
And I can assure you, despite what you're seeing, the rate is actually going to increase.
Yes.
The banks have been kept low by CBK intentionally because they were given, the requirement for the reserves that they can hold was reduced. So CBK used that to almost negotiate with them to keep the rates low for a while.
Yes.
But that is actually going to change despite what you're seeing, because I can assure you we've seen transactions whereby clients in the last year were being charged, say, 13, 14, but this year they're actually going to be charged upwards of 16 to 17. So banks, you might not see it in the retail market as yet, but it's already taking shape. It's already happening. So
Gabriel,
you might not see it yet.
Gabriel, just allow me to catch you, because, well, do you think that's exactly going to happen? But it looks as if even the bank bosses themselves are complaining. Now, we don't have this info. That some of them, what Njoroge told them is that you need to give me proposals of exactly where you need to put it at. But even with these proposals, their cash reserve was reduced just to allow them more money to lend. Do you think Njoroge is going to use that as a bargaining chip and telling them, well, I will release some of those reserves that you have so that they act as a buffer to this percentage that you want, in that you have more money to lend? That means that you can have more back to you in terms of the profit that you want to make from this.
Yes, and fair point on that. He's asked the banks to give him a pricing model.
Yes.
But think about it. Think about it this way. So Gabriel, as a customer in February, was doing just fine.
Yes.
I was still having to have a phone call with the bank every week because I was late on a payment or not. Then came the pandemic. I was unable to pay anything for 6 months or 7 or 9. The pandemic is gone. I'm still not up and running.
Yes.
How do you logically expect a bank to still charge me the same interest rate that they did? So that's one thing that the CBK will have to deal with. And I think it's something they are going to get along with and accept that, we have to reprice this and banks have to change. And like I'm telling you, fact on the ground is that we are actually seeing a change in rates. Like I said, you might not see it, but I can assure you it's happening in some of the sectors that were hard hit, and banks are able to actually take a view on some businesses, and I've not seen CBK intervene to stop them. It's not widespread,
yes,
but they've been stopped. But I think, tying to your previous conversation, this might be helpful to the shilling, because if we are being charged 18%, it might attract dollar investors back to the market, because it means maybe T-bill rates go up or profitability in the sector goes up and banks get dollar financing. So that might come in handy. So the CBK might be torn between those two things, actually.
Pretty much. Tommy, let me bring you in as well. Do you think that the CBK is taking a customer approach on this conversation for the lending rate, or just an industry approach? What do you fall this morning?
I think they're taking a customer approach,
yes,
because it's their version of a stimulus. So they're trying to keep the interest rate as low as possible so they
yes,
can have more money flowing in the economy. Now, especially that the government of Kenya is borrowing locally, so there is less competition. I mean, there's less shillings in the marketplace for Kenyans to borrow.
Yes.
So they're taking a customer approach and try to stimulate the economy in their own way.
All right, Tommy, even as you say that, let me just give you these figures this morning that we have from CBK as well. That if you look up to where we are right now, loan defaults have hit 403 billion shillings all the way. That's the figure that we have right now. And if you look according from March up to where we are right now, then you will add 53.95 billion, which was around 300 and something billion at the beginning of March. Do you think that Njoroge, looking at that this morning, that's Governor Njoroge looking at that this morning, will say, maybe now I gotta just give banks that leeway to price their products better, because that's a big one. That's in terms of defaults, 53.95 billion. They gotta recoup some of this in some way, and that is going to be through the interest rates. Do you think that we're going to see more?
I don't think that was his approach. But
Yes.
Yeah, banks do have to find a way to recoup this money that they have lost.
Yes.
Whether it's through renegotiating their loans or whether it's through pricing things better to attract more customers into the market, to their products, so they can get more products. So I mean, we'll know in time, because this pandemic is not going anywhere anytime soon,
Yes.
even though things are picking up slowly.
All right, Gabriel, just the same question to you as well. I mean, when you look at these defaulted loans that we do know now are in the figure of 403 billion shillings, and that jump from March up to where we're right now is just 53.9 billion shillings. How do you think the industry is processing these numbers? What are they saying? Is that what they're going to look at and then say, well, you see, you gotta give us a leeway therefore to price our facilities better?
Yeah, so first thing is those numbers don't even make KRA happy.
Yes.
That's what keeps coming to mind, because KRA hates when banks have to provision very high, because lower profitability, lower taxes.
Yes.
So yeah, unfortunately, the taxman has no say on this one.
Yes.
Now, for CBK, as a bank, when you're providing for these loans, you're not really losing money. It doesn't mean the loan is entirely defaulted. You're just providing for it, and banks have taken the excuse this time, because you can say I had a bad balance sheet because of the pandemic.
Yes.
My balance sheet was actually okay, but in real sense, you might have been doing crappy business for the past 3 years. But because of the pandemic, you say, okay, yeah, let's provision all the loans so that no one says we've been doing bad business, but it's just the pandemic. But as far as CBK is concerned, the banks have not lost any money. You've just accumulated the interest. You've not waived. You've just given leeway or a restructuring. So you are literally still owed. So the problem is actually on the consumer side, whereby I was paying my 50,000 per month comfortably. Now I have to pay 69,000 per month, and yet I've not yet recovered.
Yes.
So if I've recovered, and maybe I could now pay 50, but the bank actually reminds me, because of the break they gave me, I have to pay 69. So of course, there is a second challenge coming that banks are going to have. They'll have to restructure their loans and actually increase the periods. They'll be stuck with the customers they have for a longer time. And that's why I still believe they're going to have to increase those rates, because you are stuck with those customers. You cannot kick them out because of what CBK has been telling them over the last 9 months. You can't kick those people out. You can't say it's an entire default you want to sell on them. They're being forced to the negotiation table. Previously, banks were like, our hands are, it's CBK, we have to come collect, etc., etc. But now it's becoming harder for them. So I think what we need to anticipate is further conversations between customers and banks, and gradually CBK will get onto that chart, but not a massive directive whereby, price it up, because if you price it up, you're even hurting the customer more. So it's really a conundrum they're in. They're in a bit of a quagmire, but let's see how they get out of it.
All right, we take a short break here on Business, and once we come back, we are going to talk about what the Bitcoin has been spiraling upwards in that value, because we do know Tuesday last week we did see that $19,000 mark, which is just $1,000 from the golden $20,000 value in a house. We do have Alice Anangi, crypto trainer and founder, Zidane Technologies, and Kamau Nyabwengi, CEO and founder, Yena Africa, once we come back here on Business AM.